ask you, just a little bit off the back of what Eunice was just saying there. She was essentially saying how much really hangs on this meeting. But when you take a step back and you think about what this implication is for markets, and certainly with the growth prospects of China in particular, I mean, is this really going to be the panacea in terms of solving a lot of these outstanding risks like we've been thinking about, recession, et cetera?
To a certain extent, yes, actually, a lot hinges on the trade talks right now. And if we have a deal, which is what we believe is our base case, it's mutually beneficial for the two countries. A tit-for-tat trade war is just damaging for both of them, whether it's agriculture in the US or Chinese manufacturing. So yes, it's already started to show. If, for instance, in November when we had the discussions of tariff in full swing, we saw it reflect in leading indicators, in sentiment drivers, in even investment decisions, and that's exactly what we could perhaps see in a case of a repeat situation if we were not to have a deal. So yes, a lot does depend on the direction of trade talks.
In terms of that volatility, how do you expect that playing out through the rest of the month? Because we still got a few weeks to go till this meeting may or may not actually take place.
Yes, to a certain extent, it's priced in markets, and people are waiting with a lot of expectation. I think rhetoric will play an important role in terms of headlines that we hear from the two top decision makers, and that's likely to drive volatility ahead of the meeting.
Matt has a question, I think.
Yeah, hi Krithika, thanks very much for joining us. How do you position then ahead of that meeting? Because there are clearly two scenarios. We get some progress on the trade front, which would clearly be positive for markets, but then we of course saw what happened between the United States and North Korea earlier this year, where those talks crumbled in Vietnam. So that of course remains a possibility as well. So when you look at markets, we are seeing a fair bit of positivity across the Asian markets today. But when you position in markets ahead of that meeting, what do you do on both sides of the equation?
Okay, so we actually have a positive view on equities because we do believe that a deal will come through. It will underline the global macroeconomic situation and the improvement that we see thereafter. And specifically, we like US equities, particularly because they should be a bit more resilient to trade talks. We're looking at maybe quality names within the US, those companies that have actually a track record of performing really well. In China, we'd be a bit more selective. We do like MSCI China as an index play. But at the same time, we would be selective in terms of the companies and the sectors that we go into.
What's it going to mean for those two economies that, of course, have a fair bit at stake, which is the United States and China? When we look at China, earlier this year, it looked as though we were seeing some positivity coming through on the economic front, but that seems to be waning. PMIs, when you look at the official numbers, are in contractionary territory, so the Chinese economy is clearly suffering. US GDP, perhaps not as strong as it was as well. Calls as well for the Fed to do something when it comes to interest rates. So what would a resolution, this goes back to Hadley's question as well, will it be a panacea? What will a trade resolution do for the underlying strength of these two economies?
As you very rightly mentioned, we had some improvement in the months of maybe April, May, rather March and April. That has faded in May to a certain extent. If there is a deal, we would see some of that economic momentum come back to markets perhaps in Q3. At the moment, however, because of the ongoing uncertainty, we believe that there would be some action required. For instance, the Fed cutting by 25 basis points in the July meeting. If, however, there is no deal, we would see a lot more action needed in the form of stimulus support, particularly from China to prop up its economy, whether it's in the form of RRR cuts, fiscal stimulus, approvals of investment projects, that would be needed in order to also prop up consumer demand from within the economy.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.